Good afternoon. Welcome, everyone. My name is Michael Morris, and I am the founder and executive director of the National Disability Institute. We appreciate you joining us today for the webinar titled Being Money Smart. This is the first in a six-part series. We hope that you will join us for each of these sessions as we work together to share with you increased knowledge and understanding of how to really achieve a better economic future. Today's presentation will bring to you a colleague of mine, Elizabeth Jennings, and we also will have a guest presenter, Nicola Kelly from the FDIC, and Money Smart will be the title of her presentation. She'll be followed by Elizabeth Jennings, who will also facilitate a discussion and conversation with a guest that you will hear more about a little bit later on in the program. Today's webinar, let me first take you to a few housekeeping items and turn to Nakia Matthews, also from the National Disability Institute.
Hey everyone. The audio for today's webinar is being broadcast through your computers, so make sure your speakers are turned on and up and your headphones are plugged in. You can control the audio broadcast by the audio broadcast panel, which you can see a photo of here. You can turn the volume up or down, and you can pause it if you need to. If you accidentally close this panel, which is kind of easy to do, you can easily reopen it from the top menu by going to Communicate and then Join Audio Broadcast. If you do have sound capabilities on your computer or you prefer to listen by phone, you can number below and not need to enter an attendee ID. In the lower right-hand corner of the screen, there's a media viewer where we have closed captioning available for participants who are deaf, hard of hearing, or English as a second language. If you do not want to see this window, you can just collapse it by closing it down, or you can make it larger by closing down some of the other panels like the chat and the Q&A panel. If you experience any technical difficulty during the webinar, you can send me a direct message in the chat panel. You can send it to me, Matthews, or directly to the host. It will come to me also. At the end of the webinar, we're going to have a Q&A section where presenters will answer any questions you have. You can use the chat box to send your questions directly to Elizabeth Jennings. She will field your questions, or you can use the Q&A box. If you're just listening by phone or you have trouble with the chat or Q&A box, you can send your questions directly to Elizabeth Jennings at ejennings@ndi-inc.org. And just note that this webinar is being recorded, and all the materials in the recording will be placed on our website within about 24 hours.
Thank you. Let me first, before we get going, provide an absolute wonderful thank you to our sponsor, Accorda Therapeutics. We began this relationship last year with our first webinar series. I hope some of you joined us. Accorda has really helped us with really thinking through the opportunity to present to you about financial wellness and to bring together this six-part series. Talk a little bit about financial wellness. Today we're going to help you understand what does it mean, and particularly what does it mean for individuals with MS and the MS community. And we are going to share with you in this and each of the webinars that will be coming up in the next couple of weeks, strategies to improve one's financial wellness. What does it mean when we use the term financial wellness? We define financial wellness as the state of your personal finances, and really it's a part of a process of really gaining knowledge, gaining information, gaining understanding, working together towards more positive financial behaviors that will help limit stress in your life and limit stress related to managing money, making a budget, and planning for a better economic future. When we talk about financial wellness, we're really talking about multiple parts of a strategy. From my view, financial wellness may include basics around planning a budget and sticking within a budget. First, we're going to help you understand and learn more about utilizing favorable tax provisions, some of which you may be aware of, some of which you may never have heard of, but could definitely impact your opportunity for a better economic future. We're also going to be talking about accessing affordable financial services. There are services out there in each community across the country, and we want you to understand more about the choices you have to make. We'll also be talking about becoming more financially literate. And literacy encompasses more than just thinking about and preparing and managing your money. Financial literacy also includes understanding more about credit and credit. It has to do with multiple strategies to help you improve your sophistication, your understanding, your skills in building a better economic future. We're going to be talking about accessing available healthcare subsidies, building and maintaining assets, understanding public benefits, and many may be at this point on Social Security benefits, and understanding work and long-term disability options. All these are pieces of a puzzle that will be part of this and the future webinars. You may be aware, and each of us finds ourselves in a different position at this point in our lives, but I want to understand that nationally, for people between the ages of 18 and 64, for people without disabilities, up 12.8% had income below the poverty level over the past 12 months. For individuals with disabilities, that rate of having income below the poverty level is more than double that, to 27.3%. We know that no group in America is more in need and more deserving of economic recovery than people with disabilities. The Disability Institute, which I helped start some 7 years ago, is really singularly focused on working with people with disabilities across the spectrum of disabilities and their families all across the country to understand and really build an effective set of strategies customized to your own situation to advance your own economic self-sufficiency, become more financially independent. We will sell you no products. Our goal is simply to help you understand what we've learned a lot about over the last 7 years. Strategies, tools that can help you, and pathways to a better economic future. For millions of working-age adults with disabilities, attendance on public benefits for income, for health care, for food and housing becomes a trap that often requires you to stay poor, stay eligible for those public benefits. Why is financial wellness important to you and to many people that you know? Well, the research shows us that financial wellness will impact your mental and physical health. It will positively impact self-concept. It will change your status with other community stakeholders, with people you interact with, and all, it will directly impact the quality of your life. What does it mean in terms of financial wellness and MS? We were able to conduct last year a survey with the MSAA and NDI together. That survey resulted in survey responses from over 3,000 people dealing with MS nationwide. And here are things that we learned. Of the 1,000 people, 55.1% of the households were now earning less than $35,000 annually. 16.4% were less than $50,000, but more than $35,000 annually. You may well be a person in that situation. 2, we learned that when asked about the ability to pay all their bills in a typical month, 30% indicated they were having a very difficult time paying bills in a typical month, and 46.9%, almost 50%, 1 in 2, reported a somewhat difficult time. 43% of respondents reported that their financial status had affected their ability to access medical care at some point. We learned other things as well, and that 71%, almost 3 out of 4 respondents, do not have enough savings now to cover 3 months of expenses, and that 67.1% of respondents report that their finances were worse now since their MS diagnosis. We also were interested in learning whether you were aware of different tools and strategies that we've been working with people in the disability community nationwide. We're aware of them. These strategies and tools will help you stabilize your financial position and really think towards a pathway towards greater economic self-sufficiency. I asked about, were people aware about the Earned Income Tax Credit? Were people aware of IDAs, Individual Development Accounts? Were people aware of Family Self-Sufficiency Programs? And were people aware of something called PASS? We'll be talking about in subsequent webinars, which is a Social Security work incentive to help people achieve greater self-sufficiency. And what we learned is that almost 3 in 4 individuals in the MS community who returned this survey, only 3 in 4 indicated that they were not aware and had not used any or any one of these financial stability programs. So this gave us further motivation and gave us further interest in bringing together this webinar series. What we know and what we'll be sharing with you is that there are multiple pathways, there are multiple tools, there are multiple strategies that we want to share with you. On the next slide, what you have are pieces of the puzzle that we're going to help you put together. For those of you who may be on Medicaid as your access to health care, you may be familiar with Medicaid buy-in programs, which exist in over 35 states nationwide. You might be aware of Social Security work incentives, those of you who may be receiving SSI or SSDI benefits. You may be fully using a variety of tax incentives, deductions, and credits, which could help you. You might be aware that instead of going to paid preparers to do your tax returns, a nationwide network of volunteers as part of a VITA program, which we've worked on with the IRS, can help you, and there'll be no charge to prepare your taxes, and you may, in fact, get your refunds even more rapidly. We'll be talking about financial literacy, about credit repair. We'll be talking about, for those of you who may not be affiliated with a bank or credit union, the importance of starting and maintaining that relationship. We'll be talking about, for some of you, the importance of a family self-sufficiency program, which is something offered through state and local housing authorities. We'll be talking about individual development accounts, which is a mass savings opportunity that may be available to you in your community and in your state. We're talking about ways to return to the workforce if you're out of the workforce, and opportunities around self-employment, micro-enterprise, and opportunities to help you with post-secondary education as well as home ownership. I'll share with you some resources that exist in every state in the country to help you with credit counseling, taxpayer advocacy office, to help you with tax questions that you have, protection and advocacy offices that exist in every state to help you with questions that may be related to Social Security benefits, maybe other issues. And we'll also tell you about places you can go and opportunities that exist around work incentive planning. The first step in financial education really is for you to increase your financial education as something that will get you on the road to thinking about financial stability and financial security. Literacy can empower you to take charge of your life and improve your financial wellness. You need to know that in one study that was done, 42%, almost 1 in 2 Americans with and without disabilities, gave themselves a grade of C, a D, or an F, a failing grade, in terms of how comfortable they were in understanding and effectively managing their personal finances. We're going to turn next, after this brief introduction of mine, to get into a first opportunity that I think can be very helpful to you. And I'm going to turn to Elizabeth Jennings to share with you an introduction to our guest speaker, Nicola Kelly, Community Affairs Specialist with the FDIC. I know as you listen to Nicola's presentation, as we said, there's going to be an opportunity for questions after the presentation, and a second presenter has the opportunity with Elizabeth to talk to you. So maybe some notes, write some things down. There will be a question and answer period. But I want you to know, as you're listening to this first webinar, you're one of hundreds of people across the country registered today for this first of the 6-part series. That's an exciting total number of people. And what we hope is between these sessions, you can really practice your skills and practice with what the information we're sharing with you, this new knowledge, and think about what can I change in my own life? What can I do differently today, next week? How to plan for a better economic future that this webinar series is about. And again, I want to thank Accorda Therapeutics for our sponsor and helping make this possible. Let me turn it over to you.
Thank you, Michael. Good afternoon, everyone, and thank you so much for joining us today. We feel very privileged to have with us Nicola Kelly from FDIC. That's the Federal Deposit Insurance Corporation. FDIC and NDI have been partners for several years now, and we partner with them because they offer a program called Money Smart. We're going to talk about Money Smart a little bit later in the webinar, and we're going to have with us a speaker who participated on last year's webinar and after the webinar went ahead and completed the Money Smart curriculum, so she'll be able to share her personal story with you. But we feel very privileged to have Nicola with us today because in addition to the Money Smart financial education curriculum, Money Smart offers other opportunities through FDIC to help you improve your financial wellness. So thanks so much for being with us today, Nicola.
Very much, Elizabeth. Thank you, Michael and Nakia. Thank you all also. I actually feel very honored to be a presenter with you all today, and I thank you for having me. Again, my name is Nicola with the FDIC, and I've been with the FDIC for about a year and a half now. Those of you who may not be aware, the FDIC is an independent agency of the U.S. government, created to provide insurance protection for depositors in banks and savings associations throughout the United States. As Elizabeth mentioned, the Money Smart curriculum, we're very known for that. It's coming its 11-year anniversary. Matter of fact, this month's 11 years for Money Smart. And Money Smart is, real briefly, because you'll hear about it later, is a financial education curriculum that was created for those unbanked and underbanked. And it's available online, it's available by CD, and it's available by attending classes throughout the various communities. So feel free to go to the FDIC website to find out more about the curriculum. What I'll do for the first few slides of my presentation is to give you an overall understanding of the different parts of banking. For this screen, where we, the FDIC, protect these deposit accounts. Not all products that you can get under a bank's roof are necessarily FDIC insured. Some banks sell non-deposit investment products such as mutual funds, annuities, and stocks. Since it does not insure these products, keep the following tips in mind to protect your money. Invested in non-deposit products. Have enough emergency money in savings or readily accessible accounts to support you and your family. Understandably so in terms of trying to make ends meet. Sometimes having 2 to 6 months may be not as easy as expected or understanding. So invest in the products you don't understand, and be sure you have enough information before making an investment. There's an idea. So we insure checking accounts, savings accounts, money markets, and CDs. 2 fees to avoid. Both are due to not having enough money in your account. The overdraft fee, as you see where it occurs when you spend more money than you have in your account. And then non-sufficient funds, which can occur when you write a check and because of insufficient funds in the account, it comes back. And federal regulations took effect that provide certain protections for bank customers when their deposit accounts are overdrawn. Customers choose to opt into a bank's overdraft program. By choosing to opt in, what this means is that the bank can charge you a fee to process the point of sale or ATM transactions that exceed your account balance. This is opt-in rule. If you not opt in, the bank will decline your ATM withdrawals and debit card transactions at your point-of-sale terminal if you do not have money in your account to cover the withdrawal purchase. If you opt in, expect the bank to charge a sizable fee for covering the transaction. Then overdrafts and costly fees will be deducted immediately in full from your next deposits, including payroll deposits made by your employer, government benefit deposits, and direct deposits on which you may depend. These deductions will lower your account balance once again and may increase the risk of more overdrafts and costly fees. You can protect yourself from costly overdraft fees by maybe tracking the money you deposit into and withdraw from your account. And you can do this on a paper check register or electronically through online banking. Remember to track your ATM withdrawals, your purchases made with your debit card, bills that debit electronically from your account, and your checks. It may also be a good idea to keep a cushion of funds in your account, a few dollars extra, to help prevent unintended overdrafts. Find out if your bank will send you an email or text message alerting you when a significant transaction posts to your account, a recurrent automatic bill payment, or if your balance drops below a specific amount. If you may overdraw your account despite your best efforts to avoid doing so, check an account to a savings account so that for a small fee, money can automatically be moved to cover overdraft. You want to pre-arrange for an overdraft line of credit, automatic loan triggered by a shortfall in your checking account. But research what your bank and others may be charging for covering overdraft. Were mentioned. Don't use not all credit that is bad, but there are some. Say, for example, you may not want to use your credit card to pay for things to consume quickly, such as meals and vacations, if you can't afford to pay off your monthly bill in a full month or two. There's no way to fall into debt. Instead, put aside some cash each month for these items so you can pay the bill in full. If there's something you really want but it's expensive, save for it over a period of weeks or months before charging it so you can pay the balance when it's due and avoid interest charges. Try to find time to avoid late fees. And be aware that money borrowed costs money, so do not exceed your credit limit. Here's an example of why it's important to avoid carrying a balance on your card. You can pay several times the purchase price in interest. So, for example, you see for the items of movies, clothing, eating out, The original cost is $500 with an 18% annual percentage rate and it off for over a year period. The actual initial original price can actually be as much as $716. You want to think before using your card. Can you pay the entire purchase when the bill comes? And by what the annual percentage rate is, also is APR. The APR represents the cost of borrowing money. It is the yearly percentage rate. If you plan to keep a balance in your credit card account, you want it for a low APR. Then you pay the least possible interest. If you expect to pay your credit card bill full each month, it is more important to focus on the annual fee and other charges. Credit offer low introductory APRs, also known as teaser rates, for a little time to attract new customers. Credit must include clear information on how long these rates last. After the introductory period, a new rate may apply. That rate may either be fixed or variable and is usually higher than the beginning rate. Fixed, as it may sound, means that the interest rate will not change. Variable means that the rate can increase or decrease. So, for instance, of my presentation, what I'd like to talk about are steps to financial recovery. If you're short reduced income, little savings, as was mentioned earlier from the survey that was done, increases in expenses and debt, you are not alone. Once you're overwhelmed by your financial situation, it may be difficult to know where to turn for help or to begin improving your situation. This will give you some important steps to financial recovery. When we finish, you'll have information, resources, and tools to help you understand the financial recovery process. When this is the financial recovery process, we will break the process down into these 4 basic steps. We will examine these steps in more detail and discuss what actions you should take for each step. There are a few things to keep in mind as we discuss the financial recovery process. The process is a slow and steady one. It can take several years to fully recover financially and repair or rebuild your credit. You may need to ask for help along the way. This allows you to accomplish your financial recovery goals faster. For instance, a regular financial counselor may be able to negotiate lower interest rates than you can, or you may be able to pay off your debt quicker if you seek assistance through local programs, rent, mortgage, food, and utility assistance programs. Expect to experience an occasional setback during the financial recovery process. When setbacks occur, you may need to reevaluate and adjust your plan. However, try not to let setbacks discourage you or take you off course from your plan. By prepared for setbacks, you will be able to adjust and recover quicker. You are not alone. Many are embarrassed to share their financial situations with others. However, you may find that it helps to talk with and learn from others who have been in a similar situation. Begin step 1, which is to evaluate your situation. Before that, effectively evaluate your current financial situation, you must first accept your financial situation. This may be easier said than done, especially if you're dealing with the emotional aspects of losing a job, your retirement savings, investments, a partner, or your health and ability to work. Also accept that you may need to change your financial lifestyle and sacrifice certain items for a period of time in order to meet your goals and recover financially. Without the change in your financial lifestyle will be challenging, though necessary. Once you assess your current financial situation, examine your income and expenses, including your debts. Some questions to ask yourself are, how much income do I have each month? When do I receive that income? How do I currently prioritize and spend the money I receive? How do I overspend in each month? A number of ways you can track your spending, so pick a method or methods that work best for you. For instance, use your checking account statements and your check register to track your spending. Ask for save receipts if you use cash regularly. Add receipts on a daily basis or weekly basis, so you're not overwhelmed with this task at the end of each month and get discouraged. And consider writing down your cash expenses on a regular basis if you do not always collect receipts. This will help you remember how you spend your money at the end of the month. After you track your income and expenses, there are ways that you can increase and income and reduce your expenses to pay your bills. If you're unable to meet all of your monthly expenses, prioritize your expenses according to importance. Look at scenarios and how each person or persons might increase their incomes. You may be to apply these tips to your own situation. I'll tell you, Mark, the name of a character, was doing well financially until he was laid off from work. He has not been able to find work yet and is concerned about how he's going to pay his bills because he has almost depleted his savings. What steps could he take to increase his income? Possibilities may include that he seek unemployment assistance, sell some assets. For example, is there an extra vehicle in the household? Rent an extra bedroom in his home. Or talent or hobby to increase income. I have a family member who loves to bake, and that's how they make extra income. If you want to figure out how to begin decreasing your spending, start small by reducing or eliminating one new expense every month or two. Reduce expenses that are wants and desires versus needs. I remember when growing up, she used to say, okay, before you buy it, is it a want or is it a need? I thank her for that now. Think before spending or purchasing items that do not help you reach your financial recovery goals. Plan for certain items rather than using your credit card. When prioritizing your expenses, struggle to meet your monthly expenses, how might you prioritize your expenses? Your necessities such as mortgage and rent, food, utilities, and transportation should always come before paying other expenses or creditors. If you cannot make your mortgage payment or you fear at risk of foreclosing on your home, contact your lender immediately to explain your situation and negotiate a payment plan until you can resume regular payments. If you have high priority expenses, you would pay these after paying your basic necessities. High expenses may include insurance premiums to ensure you have adequate coverage on your home, contents, car, health, and life. Medicine, medical bills, health, vision, and dental expenses. And expenses you deem important and a high priority. And remaining expenses, prioritize them based on the money you have left each month. If you're unable to meet all of your expenses, ask them the ways to increase your income and decrease your expenses. Contact your creditors and explain your situation. We will contact your creditors a bit later. Now discuss the first step to financial recovery. We're on to step 2. A financial recovery plan. Why a financial recovery plan? A recovery plan will help you determine strategic ways that you can save money, pay your bills, and reduce or eliminate your debt. Your financial recovery plan should include financial goals and a spending plan to meet these goals. To reach your goals, it is extremely important to involve all family members, including the children, in determining how you might increase your income or decrease your expenses to meet your financial goals. Let's look more about setting financial goals. Before you create a spend plan, you have financial goals in mind. Here are steps to help you set financial goals. Write down your financial goals to keep you accountable and focused on your goals so you don't get deterred or swayed. Your financial goals are SMART, which stands for specific, measurable, attainable, or achievable, then time-bound or time-based. For example, she wants to buy, say, a home within 5 years, and she would like to save a certain amount of money for the down payment. If she can save, say, $3,000 each year or $250 each month, she can reach her goal. Her goal is specific, measurable, and time-bound. It is relevant to a need or desire she has. However, if she has experienced a financial setback, her overall goal and her yearly and monthly goal may not be attainable within the time frame she has set. And we'll go back to this example a little later. Organize your financial goals by time frames. For example, you may have an immediate goal to develop a spending plan and future goals to pay off your credit card debt to save. Your progress. To make your SMART goals smarter, you must evaluate and reevaluate your goals. They may change. If you're making satisfactory progress toward reaching a particular goal, reevaluate your approach and make changes where necessary. The way to start taking control of your financial situation is to develop a personal spending plan. A spending plan is a step-by-step plan for meeting expensive financial goals in a given period. Following is a spending plan. A spending plan helps you to know what your income and expenses are each month, reduce the anxiety of not being able to meet your expenses, gives you some control over your money because a spending plan is all about choices and how to use your money. And it helps you to build assets that will improve the quality of your life for you and your family. There are different tools you can use to document your spending plan. For example, there's the monthly payment schedule, monthly payment calendar. There's an expense envelope. Now, I don't know if any of you had the experience, either growing up or currently, where you have a family member who has payday, they lay out a certain number of envelopes. And envelope, they write on it what that expense is. And for that month, they place that amount of money within the envelope. That is the amount of money that month that they use and no more of it. And that's how they're assigned to each of their monthly expenses. And then there's also the computer system. They have various spreadsheets. You could create a spreadsheet, or they have personal finance programs available at low cost. Records helps you to successfully implement and follow a spending plan. Now we're ready to move on to step 3. Implement your plan. Implement plan means that it's time to put your plan into action once you have evaluated your current financial situation, established your financial goals, and developed a financial recovery plan. When you put your financial recovery plan into action, you may need assistance to help cover your monthly expenses, such as your mortgage or rent, food, utility bills. Try and learn about local, state, national assistance programs. Ask friends and family members if they're familiar with any assistance programs. Contact utility providers and ask about assistance programs, or visit their website for information and enroll if applicable. Look for banks and national food assistance programs that may operate in your area. And also seek referrals through your employer assistance program, unemployment office, a financial counselor, or financial advisor. If you make too much money to qualify for assistance programs, do not assume, please. Check regardless of your income level. There are programs available that do not have income guidelines or provide benefits to those in a medium to moderate income level. Say, for example, they're making home affordable program. And this is a critical part of the Obama administration's broad strategy to help homeowners avoid foreclosure, stabilize the country's housing market, and improve the nation's economy. Maybe your expenses have increased due to medical bills, or you're picking up the pieces after a life change. Maybe you're trying to get That's because of your hours were cut or business stumbled. In any case, it's important to be proactive. Making home affordable can help get real help and real answers right now. And the website, benefit.gov, was launched in an effort to provide citizens with easy online access to government benefits and assistance programs. Extension of financial setback, there are two ways to rebuild your credit. Do self or use a reputable credit counseling agency. Share your own credit. Order a copy of your credit report. Identify and correct any errors. Ask your creditors to explain your situation. Negotiate payment plans with your creditors when you have some money to pay them. And then mentioned earlier, opt out of receiving unsolicited offers for credit cards to avoid temptation of applying for them. When they're frequently in the mail, that's the first, it's tempting to want to find a solution, maybe and possibly a credit card. When trying to recover financially, it's important to review your credit report and ensure there are no errors impacting your credit score. The Fair Credit Reporting Act requires each of the credit reporting agencies, which are Equifax, Experian, and TransUnion, to provide a free copy of your credit report at your request once every month, 12 months. I have experience with you get 3 credit reports every 12 months, as it may be to step it, or 1 credit report the first third of the year, the second report the second third of the year, and the third report the last third of the year. Therefore, you'll have a constant information on the status of your credit standing. And again, your credit report, from what you see here on the screen, this is the only online source authorized to do so. Beware of other sites that may look and sound familiar. Responsibility to ensure that your credit report is accurate. Credit report agencies do not check the accuracy of reported information unless you ask them to. It's best to view your credit report from each of the 3 credit bureaus, or at a minimum, before making large purchases. If you error on your credit report, contact the credit reporting agency and write a letter disputing the error. And make sure to remember to keep a copy of the letter for your records. You may also be able to file the dispute online through the credit bureau's website. The credit agencies are required to conduct an investigation within 30 days of them receiving your letter. They're all a credit score. That's what the credit reporting agencies have available, and that's what lenders and creditors look for in terms of basing or not to allow you or provide you with credit. On the left, you see the FICO score, and the FICO score is the main factor lenders consider when deciding whether to grant your credit. A FICO score is calculated using a computer model that compares the information in your credit report, what is on the credit reports of countless other customers. FICO scores usually range from about 300 to 850. The higher the score, the lower the credit risk a credit will see or deem you as. VantageScore, in 2006, the 3 credit reporting agencies, and they had agreed on a new credit scoring system called this VantageScore. Because all 3 credit reporting agencies will be using the same scoring system. You have the same VantageScore for each agency. The score for this ranges for this VantageScore ranges from 501 to 990, and it also groups scores into letter categories, covering approximately 100-point range, just like grades you receive back in school on a report card. For example, if you had 501 to 600 points, your credit grade would be an F. If you had 901 points or more, your credit grade would be an A. And I just mentioned that in terms of the credit scores and the types that they have. FICO score is what's usually used. And again, in terms of opting out, here's the phone number and the website. Calling this number will put you in contact with the consumer credit reporting industry, where you have the ability to either remove your name for 5 years, so their call would not automatically call or send you information about credit cards. Also, it permanently removes your name. You add your name after those 5 years. You have the option. You can add your name back. And also, call this number. You can hear more details on the actual opt-in and opt-in out program. It's important to make sure that your credit report is accurate and you have not become a victim of identity theft. Identity theft occurs when thieves steal your personal information, for your Social Security number, birth date, or credit card numbers, and use your identity to commit other crimes. Three of the types of identity theft. Phishing, where you get emails from it looks as though it's a legitimate source, and come to find out that it's not once you run. Also, farming, which sounds similar to phishing, but these are actual websites that when you go to, once you get to it, your information is actually taken and then used for the person's use. And that's skimming. And this credit card information, you may go to order something online, or you go to a dealer and your credit card information is taken and used. If not recognized in telemarketing fraud, are often targeted based on the theory that they're trusting and polite to strangers. So that's why you see that they're often targeted. A lot of phone scams occur this way. And that you are a victim of identity theft, the information recommends that you immediately take the following actions. File a report with your local police and get a copy of the report. Contact your creditors about any accounts that have been changed or opened fraudulently, and ask to speak to someone in the security or fraud department. Sign up and write and include copies of the documents that were discussed or submitted. Keep records of your conversations and all correspondence. I remember I was a victim of identity theft many years ago, and it was through my keeping the names of the persons that I spoke with, information that we shared, that it was much smoother to get the problem resolved and my identity rectified. Identity theft, the identity theft affidavit that you can find at the FTC's website to support your written statement, and file a complaint with the FTC, which is the Federal Trade Commission. Verification that the disputed account has been closed and the fraudulent debts have been discharged. All that to keep in mind is be careful if you download software on your cell phone or any software that you may use online. Okay, and I'd like to talk about before paying your creditors. With building your own credit, it can be challenging to deal with creditors. You may be pressured by creditors and lenders to pay bills first. However, you should pay your basic necessities, as I mentioned before paying other creditors. Before you contact your creditors, determine how much you owe each creditor, how much you can pay each creditor, and which you should know after completing step 2, which is to develop your financial recovery plan. When you can realistically pay a creditor if you're unable to make a current payment, and so to know if you should contact your creditors. If you can pay your creditors, be prepared to explain in detail why you cannot pay them or why you have fallen behind on past payments. Any efforts you are making, for example, increasing your income, you're trying to decrease your expenses in order to pay them, have a plan of when you can realistically pay them and how you can pay them. Contact your creditor by phone or letter. However, if dealing with a local creditor, say a bank loan officer or a store credit manager, a physician, hospital, or a dentist, you may choose to have to talk with them in person. Consider the following tips when talking with your creditors or contacting them by phone. Document the conversation. Write the name of the creditor and representatives you spoke with, the date and time of the conversation, and the discussion points or decisions made by you and the creditor. Many creditors want to work out a solution to the debt that works for you and your budget, so please try to stay calm. And be honest with yourself and your creditors. Do not accept any deal that you can't fulfill. Be firm in stating what you can realistically pay and when, because you want to be able to follow through. You may choose to contact a credit counseling agency when rebuilding your credit. A credit counseling agency might be right for you if you need help creating a spending plan, have trouble sticking to a spending plan, you prefer to negotiate with your creditors or cannot work out an acceptable repayment plan with them, or are unable to keep track of bills. Help you manage your money and debt, and they can help you to develop a spending plan, and about consumer credit, money, and debt management by offering free educational materials and workshops. If you decide to use a credit counseling agencies when rebuilding your credit, the Federal Trade Commission provides tips for choosing a reputable credit counseling agency at their website, which again is www.ftc.gov. In credit repair scams, only consistent efforts in making payments on your debt will improve your credit. Therefore, choose your credit counseling agency carefully. Some businesses make promises about repairing your credit that they cannot deliver. Beware companies that promise to erase your bad credit, to remove bankruptcies and judgments from your credit file. No one can have accurate information removed. They promise fast and easy credit repair. If you have bad credit, it can take years to repair your credit legitimately. Beware that offer to create a new identity for you. If you make false statements on loan applications or use a fake Social Security number, you will be committing fraud. And you can also be charged with mail or wire fraud if you use a telephone to apply for credit and provides false information. When you pay for credit repair services before providing any service, legitimate companies provide you a service before requesting payment. There are companies that will not tell you your rights and what you can do yourself. Remember, you can write your credit report yourself. If you have errors on your report, you can also request that the credit reporting agencies make appropriate changes, as I discussed earlier. In the final section, I'll discuss how to review and adjust your plan. There are many unexpected life-changing events that can impact your financial status. Therefore, you should regularly review your financial situation, adjust your financial recovery plan accordingly. Consider reviewing your spending plan on a month or two after implementing it, and periodically thereafter, maybe every 6 months. For goals and spending priorities every 12 months, consider reviewing them or after a life-changing event. And consider reviewing your credit report at least 12 months to check for errors and monitor your progress in building your credit and before applying for a loan. You may need to review and adjust your financial recovery plan when your income and your expense change, increase or they decrease, accomplish, adjust, or create a new financial goal. When you transition to a new life stage, be it get married or changing experiences, children are have to provide for college education, and before something unexpected happens. When reviewing financial recovery plan, do not forget to review any insurance coverage, retirement plans, and investments you have. Insurance is an important part of your money. It is protection for you and your family from financial loss if the unexpected happens. You can insurance to protect you if you become ill or disabled or are unable to work, to protect you in the event of an accident or property damage, or to provide your loved ones in the event of a death. If you do not plan ahead and protect yourself with insurance, you may have to use funds set aside for other financial goals or emergencies, or get into debt by borrowing money. Your insurance covers at least once a year. If you own a home, know that natural disasters are covered by your standard homeowner's insurance policy. People take money out of their retirement or investment accounts when they suffer a serious setback, and in the process they must pay thousands of dollars in taxes and penalties for withdrawing the money. It may deplete or greatly decrease the amount of money they had saved for retirement or other expenses. Others may experience investment losses due to the risky or poor investment choices or a drop in the stock market. Here are tips for reviewing and rebuilding your investment portfolio. Your investment portfolio at least once a year when you experience any major life change or when the market changes. Review adjustments in your allocations according to your risk tolerance and the amount of time you have before you need the money. And once you are on the path to recovery, you should consider rebuilding your savings. This allows you to pay for extra expenses without disrupting or derailing you from your financial recovery plan. These extra expenses may include unexpected home or car repairs and other unexpected expenses like expenses occur once or twice a year, property taxes or insurance premiums, and the unforeseen future expenses. If you pay for extra expenses with your savings, you can avoid paying interest and fees you would be charged when using a credit card. However, there are a few tips to consider beginning to save. Small, understandably so, you may only have a little to start with. Start small and slowly increase the amount of money you save. Be respectful of your savings and only use it when necessary. For example, if a car breaks down and you need to repair it. Make extra monthly payments to yourself once you paid off a credit card or loan, or when you receive extra income. In other words, if you can afford to, you've made the final payment on that bill. Use some, if not all, of that money to savings, to help your savings. And you've learned about, or I hope you've learned about the steps you can take to recover financially. Even faced with financial setbacks, now let's review some. So now let's review some actions you can take to stay on that road to financial recovery. You can rebuild your savings to pay for the extra expenses, and avoid incurring debt while trying to recover financially. Continue to apply what you have learned about financial recovery and managing your finances. Keep moving forward. If you experience a setback or get off track, do not panic or get you down. Learn from any mistakes you have made. Make adjustments and get back on track. Be patient. Remember, the final recovery process is slow and a steady one. It can take several years to fully recover financially and rebuild your credit. Educate yourself. Continue to educate yourself and learn how you can better manage your finances, like coming to webinars like these and all the other ones NDI have in store for the following and upcoming week. Every situation is unique, so take what you have learned and determine how it can be applied to your situation. Ask help and talk with others in a similar financial situation. People do not like to disclose their financial situation to others, but you must be able to recognize when help is necessary so you can achieve your financial goals. You may also feel better if you can share your situation with others who understand what you are going through and can offer help advice. conclusion, my hope is that you have learned about developing and implementing and adjusting a recovery plan in the time that we had allowed, identifying ways to increase your income and decrease your expenses, prioritizing your spending and developing financial goals and spending plans, and rebuilding your credit and how to avoid repair scams. I hope you are now equipped to take steps towards recovering financially and rebuilding your credit. Thank you for allowing me to present to you, and I will now pass it over to Elizabeth.
Thank you so much for that very valuable information. I hope everyone on the line has been able to glean at least one or two things from Nicola's presentation. I know that for myself, one of the things that I learned from FDIC is to write down everything that I purchase. So any money that I spend gets written down, and it's really proven to be a wonderful way not only to keep track of expenses, but to take a look back and see where dollars have been spent that possibly could be put back into my budget or even into savings. So thank you, Nicola, again for those great tips.
You're welcome. Thank you.
We have an individual who participated on the webinar series last year and let us know in some follow-up surveys that she had participated in the first webinar, being Money Smart, and she had subsequently participated in the Money Smart curriculum. So I invited her here today to share her experience with all of you on the line and to answer a few questions with us. Marie, are you with us?
Yes, can you hear me?
I can. Welcome, Marie. Thank you so much.
Wonderful to be here, Elizabeth.
So let's start out with a first question. How has MS impacted your financial life?
Well, it's a negative impact. Just as I was coming into what I expected to be my high-earning years, MS knocked me out of the workforce. I ended up spending $16,000 out of my 401k when I had to stop working because of MS, and keep family going when I wasn't working. And then I had a private long-term disability policy that I had kept going from about 12 years ago now, from a job that I had left, and I knew if something ever happened to me and I couldn't work, I would need a disability policy that I could count on. So I always paid my premiums on that, but it was high wages from 12 years ago, capped at 60%, and then capped at $4,000 a month. So eventually I met the criteria and the disability started coming in. So it's had a big impact on me because now I can live on disability payments, and so impacted my financial life. Yes, it has in a big way.
I'm sure you're not the only one who has experienced some of those similar things. So you did participate in last year's Being Money Smart, and why did you complete the curriculum, and what did you think of it?
I did the curriculum because I felt a sense of panic and fear and loss of control in my life. An overwhelming sense of pressure about money, and by completing the curriculum, it helps at all of those money topics that we know there are. We should be doing these things. Yes, let's do this. Let's do this. Let's do this. It got me back on track with things that I needed to do, reminded me of some things that I had forgotten about, and the FDA class gave me some calm, and it got doing some things that I needed to do, like instead of in this kind of spreadsheet where I tracked my expenses, I started using Mint.com, which is free internet-based, just lets you set up budgets and and saying, oh, this is where it's all going, you saying, this is how much I'm going to allocate. And it changes your perspective, and you have little bars, and you see when you get in the red, you are allocating more than you have. So
that's
thank you.
That's great. And for all of you out there, Nakia just sent to you the mint.com website, and we're actually going to provide it for you in a few minutes as well. Marie, have your financial goals changed since you completed the Money Smart and since you started having MS?
I was a professional, and then I looked forward to probably retirement with, visit the kids and maybe go to Europe kind of thing. And now the combination of S and spending a chunk of my 4K and all these things, I'm wondering what's happened when I'm 65 and my long-term disability stops paying, and they keep doing to Social Security and Medicare, and I'm sure what's going to happen to me when I turn 65. And I never thought I would be one of those people that's wondering, are my kids going to support me? But yet found enough money in my budget to be getting a new building so that I can support myself after age 65. And so I went from having sort of a known good future to cloudy and not like that. It's on the list to sort of get that fixed, but I'm all the way there yet. My goal range, I used to be sort of an optic for bright future, and I'm still now at I don't have cable TV. Still, we don't go out to eat dinner. It seems a lot.
It's like, though, that you're making the hard choices that a lot of us have to make. So that's a great first start, Marie. Is there anything else that you'd like to share?
Just your budget, the better.
Great words for us to live by. Marie, thank you enough for spending your time and for being so open with all of us as a group. Thank you so much.
You're welcome. It was a pleasure speaking with you.
Thank you, Marie.
Right. Bye.
Take care. So some of you are starting to send in questions, and we're going to start answering them in a few minutes. I just want to provide you with a few more things. The first is a suggestion, kind of challenge to all of you on the line. We'd really recommend that you take a few next steps. I'm going to offer a few suggestions to you, and we're going to check back in with you over time to see if you set a course to do one of these things. The first is to take a financial literacy course of your choosing. There are many financial literacy courses available online, and there are even many available in your local community. So we encourage you to take that first step. Many Americans have never participated in a financial literacy course. So even if you think, I pretty much feel like I've got it, it may be a great first step to do just what Marie did and go ahead and take a financial literacy curriculum, get all of those great reminders, start looking at your budget, seeing where there may be places that you may have some opportunities that you didn't recognize previously. So we suggest that you set a goal to finish a course over the next 3 months, and then we're going to send out a survey to you to see if you did that and what you thought, and maybe some suggestions you might have to others for the next time we get to meet together. We think you may want to choose to ask for what you want or need from your bank. If you are paying fees at your bank, shop around. If you want a lower credit card rate, we suggest that you ask for one. And we give you all of the links that you may need to shop around for a new bank, how that works, some steps you can take to move your money. Or if you're thinking about asking for a lower credit card rate, there's a great blog that gives you step-by-step instructions on how to request a lower rate from your credit card. You may or may not get it, but nothing ventured, nothing gained. Again, over the next few months, we're going to send you a survey and see what you did and get your feedback on how it went for you. I suggest that you join our upcoming webinars. Nicola mentioned that one of the things that you can do to increase your financial stability and get on a path to recovery is look at your income. Are ways for you to have increased income. And many of you on the line, you may be concerned about work, both in regards to your long-term disability payments or in regards to your Social Security benefits. And some of our upcoming webinars are going to help you with that. In particular, on October 17th, we're going to give you a rundown of what Social Security's rules are for individuals who receive Social Security disability insurance and want to return to work. We're going to let you know what the income limits are for this year and how you can write off, much like tax deductions, some of the expenses you have related to your disability that you pay to go to work, like your medications, or if you have had to modify your vehicle, anything like that. We're going to talk about together on October 17th, so we'll hope you'll join us. I did you here on this slide with some financial literacy resources. These are all different financial literacy curriculums that you can participate in. You can take your choice. We just suggest that you choose one and explore it and let us know how you did. There's some great games out there. You can have a lot of fun with your financial literacy by playing games. It's a great way to learn and a fun way to include your kids in the process. Top one, Visa Financial Soccer, is a game that NDI did in partnership with Visa. So when you play the game, it's a really fun, interactive soccer game. When you play, you not only get questions about financial education, but you also get questions about Social Security benefits. So you can learn about financial education and about Social Security benefits at the same time. Finally, we're offering you some financial empowerment tools. One of the questions that came up is, are we providing you with secure sites? And we are. You can always tell that a website is secure if it says HTTPS. That lets you know that it's a secured site. Many of us on the staff use these websites. That's why we recommend them. Mint.com, as Marie said, is a way for you to keep track of your money online and do online budgeting. Love My Credit Union gives you a chance to explore less expensive financial institutions, credit unions, and all of the benefits that they have to offer. My Money Checkup is a way for you to give a checkup on what your financial status is now. And LearnUs.com is my favorite financial stability blog. It's really directed to women. Sorry, guys on the line, although several men in the office also enjoy it. It talks to you about lots of the everyday needs that individuals have and gives innovative solutions, personal stories, lots of creative opportunities for people to find more money in their budgets, and also a way for them to think about what they're spending and how others are handling their decreased income. I see in the chat box in the Q&A we have others giving some other ideas that they have, and so while you may not have explored those, if you want to check those out, we welcome you to do so. We're going to start to answer some questions, but if we don't get to all of them, or if you have a question after today's webinar, I want to invite you to reach out to me, Elizabeth Jennings. You have there my phone number and my email address. So if you need something like a personal resource in your local area, I'll do my best to help you to locate that and to help you with any of the financial stability questions you may have. Okay, we're getting into the Q&A. So, Nikia, if we could make sure that Nicola is unmuted in case there's a question for her. This comes from Vivian. I have a consumer who is looking for a lending company to refinance his house. His current mortgage company does not want to refinance his home because he does have enough income. However, this consumer pays his mortgage on time and has no default on his payments. So, Nicola, I would ask you, do you have any suggestions?
My thought that comes to mind is we're able to give out, endorse any type of lending company or organization. Has the customer spoken with maybe a credit counseling agency to get input on it? Because their payments are on time. It sounds as though it may be pertaining more to the income that may be the reason for it. So you get input from or counseling from a credit counseling agency.
That's a great suggestion. So for many of you, you may be wary at times of credit counseling organizations, but there are many out there that are not-for-profits that have very good reputations. And if you're not sure where to turn in your local community, again, I invite you to email me, and I will help to connect you to one. Next question is, I don't have enough money to pay my mortgage, utilities, and medications. I rely on family members for money. What type of help is there for me? This is a great question that I think a lot of people on the line would have, so thank you, Donna, for sending that in to us. So in each local community, there may be some resources to assist with financial support. It really depends on the local area and what their income and asset limits are for individuals to receive support. This is another question that gets very localized. So, Donna, I'm going to invite you to email into me, and anybody else on the line, if you have a question similar to this, shoot me an email so that I can look into your local area and see what your local community action council is doing and what kind of opportunities there may be in your local area or through your state. In many states, there are Medicare support programs, and we can also look at information on that to make sure that you have all of the information to reach out to whatever types of supports may be available. So we have a question from Michael who said it's hard to budget with 2 teenage kids, and does anybody have any suggestions? And we, well, first turn to Nicola to see if you have any.
I'm a parent of 3 that have 3 things. I'm sorry, not thought. In terms of the increasing and decreasing, have you considered in what expense areas addressed in terms of decreasing them? In other words, from the question, I don't gather how much you've done to this day to increase expenses. So I'm trying to understand, and my thought is that you look at areas in which you can decrease the expenses within your household. And all the, sorry? Hello?
Oh, no, I think it was just a hiccup in the line. You have the floor.
Right, yeah. So as discussed over with the presentation, it's looking at the current expenses and what areas, possible areas for decreasing expenses.
That's a great question. All of you on the line with youth may also want to consider, while you do Money Smart, that you also have your youth do Money Smart for Youth. Money Smart for Youth is a great program, and it would help to build financial literacy of your teenagers, which could benefit you as a family as you talk together about budgeting and decreasing expenses, and also give your youth a great foundation as they head off into adult life. We are a nation of debtors. We are a nation that is seriously limited in our financial education, and as you build your own and build your families, you'll be serving yourself well and serving your children as well.
Yeah, and to add, Elizabeth, the question in terms of the communication of it also, communicating with your teenagers for them to be aware of what is able to household and what is not. And yes, knowing all the different curriculums, all of them are free. And the one that Elizabeth mentioned is called Money Smart for Young Adults. And it goes from middle school to the second year of college. So they'll come in very handy for the teenage.
It's a program, and it's free and it's online, so it's a great way to have the whole family participate. The question we received is, realistic is self-employment in this economy for a person with a disability whose expense far exceed that of a non-disabled person? And I wonder if we still have Michael Morris on the line if he wants to add something to this question. Okay, Michael's mute. I'm going to go ahead and start. Self-employment is a really powerful tool for individuals with disabilities. Although there are some necessities anytime somebody starts a business, there are things to consider. The public benefit rules around self-employment are really favorable, especially Social Security. So self-employment provides an opportunity for individuals, particularly those who need to consider how much they're going to earn because of the need to maintain a public benefit. It provides a lot more room because your net earnings are looked at instead of your gross earnings. It also allows for people to set their own times, consider their own personal needs. We can connect you to several programs that are focused on self-employment for individuals with disabilities, as well as some great websites that provide webinar series that have been archived, particularly to show individuals with disabilities some of the benefits that self-employment may hold for them. So I got this question from Nikia, but whoever asked it, I hope that you'll reach out to me and anybody else who's interested in self-employment, and we will get you connected to some really wonderful resources that could help you with that opportunity. We have a question, which I think is one for you, Nicola. Will credit counseling impact my credit report? And I think the question is really, will credit counseling negatively impact my credit report?
Credit counseling is to prevent a negative impact from your credit report by educating you on what the various aspects of your credit report, your credit, your do's and don'ts. So no, credit, being a counselor will not negatively impact your credit report.
Wonderful, thank you. And I see just one more question, so if you have another one, now would be the time to send it out. But the last question that I see is, how can I get a copy of the PowerPoint? This webinar, along with each of the subsequent webinars over the next few months, will be archived on our website. That's www.realeconomicimpact.org, and Nikia put up the website for you right into the chat box. So if we recommend strongly that you register for the upcoming webinars, but if you happen to miss one, they'll be archived on our website. You feel free to let others know, hey, I attended a great online webinar and here's where you can listen to it. It's also wonderful for you if this was a lot of information today. We encourage you at any point in time to access the archive to listen to it again. And we're going to have this archive ready for you as early as tomorrow. So you can visit our website starting tomorrow and view an archive of this webinar, and then register for the other webinars. And if you miss one, just go ahead and come back to our website to view it. I will say thank you again to Nicola and Kelly from FDIC, and to our special guest speaker, Marie. You both did a great job, and I really appreciate your time today.
For having us.
No problem. Thank you. Again, if you have any questions, please be sure to email me or give me a call, and I'll be happy to support you as you define your path to financial stability. Thank you, everyone.